Well, I think the thing to stress to your viewers is that inflation expectations in the future are really contained. Even though we keep getting these prints at 40-year highs, future inflation expectations, whether you look at it in the inflation protected treasury market or the yield curve, the market is priced for a disinflation transitory. The Fed might have retired that word, but the market has not. So the market is super complacent that the Fed hiking these policy rates is going to cool inflation in the future. And I think that's where the opportunity exists for investors because it's not priced into future expectations. And the Fed hiking policy rates, to Steve's point, is it going to put more airline pilots in the sky? Is it going to do anything to fix the service side in the job market? It's not. It's not doing anything to address the supply side.
And yet, Betsy, it's the only tool that the Fed has.
It's the only tool they're using. The balance sheet is the big, variable out there that they could do more with. They really haven't, I think, been aggressive enough about reducing the balance sheet.
That would be a huge drain to liquidity at a time where we're worried about liquidity being an issue in market stability.
I know, and that's why the Fed's really in a pickle, and that's why it's a great time to buy inflation protection in the portfolio because they have to, at some point, use the balance sheet more, ease off, because we're on the brink of a financial crisis right now in Europe with what's going on in the UK.
Betsy, just your thoughts on this. Does this change your economic outlook? I mean, Jamie Dimon saying that we could be looking at a recession in the next 6 to 9 months. You see numbers like this, know that the Fed's going to have to keep its foot on its foot on the gas pedal. What does that mean?
Obviously this isn't a report that anyone likes to see. At the same time, I want to say that we should never overreact to one report. I mean, what do we see here? We saw really fast inflation in services. If you look at services less energy was up 0.8 for the month. Shelter was only up 0.7. So what's going on? Well, we're just seeing basically services across the board. Prices are going up. Why are prices going up? Because real wages have fallen because of inflation, and yet the labor market's super tight. So how do you hire people when you're actually paying them less in real terms than you were paying them a year ago or 2 years ago? So what's happening is we're getting wage pressure, and that's happening in sectors where a large share of their costs are workers. And so that is going to pass through to inflation. There's some of these industries like education where we knew this was going to happen because the seasonal adjustment just can't really correct for the kind of pay raises that teachers and other education providers needed at the start of this past school year. So we sort of expected that, but things like veterinary services were up 1.9% this month. Like, vets are just sick of taking care of your dog and cat at declining real wages.
Yeah.
That process has got to slow, or we're going to end up with something that looks like a wage price spiral. I don't think we're there yet. And I'm not that surprised that we're seeing these kinds of corrections in wages. But this is definitely what everyone's going to be worried about. And it's why we need to do what we can to increase labor supply.
Neela, let's do a reality check here. Let's imagine this is 6 months from now. And we look back on the September inflation report and said, darn, if only we'd seen X in here, we would have known inflation is going to come down quickly. And this is the same mistake the Fed made. Is there some argument to be made? Because you do have people, as Andrew mentioned, like Barry Sternlicht coming forward, Jeremy Siegel coming forward and saying, you idiots, you're missing the big story. Neela, are we missing the big story of inflation coming down? I remain completely open to being completely reversed on my thinking. I just can't see it in the data yet, but maybe you can help me.
The big story, Steve, unfortunately, in my view, is not optimistic that we're missing. The big story is borne by housing. This is a market that has been chronically undersupplied for about a decade now. And it's because of a whole host of reasons we could go into if we called our friend Diana Olick. But the real issue that we're missing is the labor market. This is a market on the verge of undersupply, not just for the next 6 months, but maybe for the next 6 years. This trend started before the pandemic.
Neela, I have to interrupt you because it's a huge issue. We're addressing structural problems in labor, structural problems in the housing market with cyclical monetary policy from the Fed.
Although, Neela,
that's right.
We're cutting off our knees to spite our face. Wait a second.
Finish, and then I've got another question for you.
The Fed's hiking from rock bottom zero levels. So the impact of the Fed policy is going to take a little bit of time to catch up. We're not starting from 3% federal funds rate. We started from near zero. Around the world, it was negative. So there's some places to go on this. But if you look at the jobs market itself, this is an undersupplied market, not just with people, but with skill sets, the skills that companies are demanding now. That's why you're seeing the dynamics that you're seeing in the labor force participation rate. There's just not enough people and enough skills to accommodate the demand. So what does that look like for the Fed? Well, it looks like a 2% target that's increasingly a relic in the context of a shrinking workforce.